Thanks for watching Harnessing the Storm. I'm super excited today to have Eric Satz, CEO of Alto Investing. He has a diverse background. He's been an entrepreneur, an investment banker, a VC, lots of different skills and abilities. It's fun to go through his background, his opinions. Really smart guy, very opinionated, fun to interact with. We touch on a ton of things in this interview. We talk about the public stock market, where it's headed, probably down. We talk about alternative investing, healthcare. We touch into The Simpsons and politics. It's really fun couple minutes. Please watch it. I think you'll really enjoy it. So here we are with Eric Satz, CEO of Alto. Eric, you and I have known each other a long time. Excited to hear about your new venture in Alto, alternative IRA. Before we dive into that, just for the audience, give a quick summary of your background, because you've been an entrepreneur, a VC, and now you're sort of walking in the middle, sort of helping to make that market more effective, more efficient.
Yeah. So first of all, Vic, thanks for having me on. And, I actually think my entrepreneurial activity started back in high school when I was selling frozen lemonade out of an unair-conditioned van in Miami, Florida. And the economics and the business model were really straightforward and simple, unlike a lot of the companies we see today, right? It was the more you sell, the more you make. Yeah. I mean, really easy to understand.
And you can't drink too much of your profits.
No, actually, you start to feel sick. So there's like this built-in, governor on drinking your profits. A lot of sugar. But then going to college, actually had a newspaper distribution business, and again, selling the New York Times and Boston Globe, and same business model, right? The more I sold, the more I made, which typically meant the more I went out to eat.
So did you do that at Amherst? I didn't know. So Eric and I went to school together. I didn't realize you were selling the Globe and the New York Times.
Yeah, I used to get up really early morning and drive my car places on campus that you weren't supposed to drive in order to make the distribution a little bit faster and easier for me at that hour. Unfortunately, it meant I would usually miss like the 8 a.m. class start time. But things seem to have worked out okay on that front. And so, as I think I went from college to Wall Street and was an investment banker for a long time. Left to start a coffee company in New York City. Ran back to Wall Street when I figured out that I was really good at restructuring, which is what I had to do with the coffee business that I had started. And eventually made my way to Nashville. My wife, who was also an Amherst grad, as you know, in your class, I think, the son-in-law capital of the country. And together we started a company called Plum Good Food, which was an online organic home grocery delivery business.
Right, and I was an investor in that, really ahead of its time. A great idea. Slightly too early, probably, for the market, but incredible.
Yeah, so I think too early, certainly for Nashville, and I also, I'm going to own this. I think we had a business model that could have worked had we stuck to it, and by that I mean, in the early days, and you may remember this, the idea was if you lived in a given zip code, a given part of the city. Right. Then you had one delivery day. And, that helped build artificial density, if you will. And we also had this time requirement, which was, hey, you have to get your order in 48 hours in advance of your delivery day, which put psychological pressure on the shopper to say, oh my God, I got to get my order in. Yeah. And so what we heard was—
And help operations, obviously.
Absolutely. Right. And sort of just in time inventory stocking and flow. And so what we heard was, hey, I really like to cook on the weekend, or I really like to cook during the week. And so what we then tried to do was, and then actually this part was also successful, which was, okay, you get an early, you could get Monday, Thursday, Tuesday, Friday. And if you lived in a part of the MSA that was more of a distance from center Nashville, then you got Wednesday, right? And that was actually working, but there was this idea that, look, if we're gonna grow and if we're gonna be a big business, then we need to let people order by midnight the night before, any day of the week, which sounds good from a customer standpoint, and most customers think they want that. The problem is we were a logistics business, right? And so while people could order online and there was a big technology component, at the end of the day, at our core, we're in the logistics business. And from an operational perspective, allowing people to order no matter where they lived any day of the week by midnight the night before meant we had to grow our fleet of trucks 3 to 4x. Right. Which created unsustainable overhead for a city the size of Nashville at the time. Now, we both know that Nashville.
Really interesting. I think that for entrepreneurs in the audience, the lesson is you need to stick to the core mission and not let customers or investors or directors or someone you meet at a coffee shop say, hey, you should try this. I've seen it work in LA or the United Kingdom or whatever. Because if you had stuck there, it would have been a smaller business, but it would have been successful and you could have grown into bigger.
No,
every day you need to be, I don't know, raise $400 million, $500 million, and that's hard in Nashville. It's not going to work.
No, definitely not going to work. And I think what you just said cannot be driven home enough for fellow entrepreneurs. And that is, my instinct said, stick to our knitting in terms of limited days of delivery. And, I listened to others with respect to this idea. In order to grow, in order to meet customer demands, we needed to do it by midnight the night before and delivery every day of the week. The irony here is that if you give the customer the ability to order up until midnight the night before when they need their groceries, the irony is that they don't do it. And the next day they say, oh my God, I need milk. And they run to the grocery store, right? But if you set this artificial deadline of, hey, you need to have your order in 48 hours in advance, there's this psychological pressure of, I don't want to have to go to the store. I'm going to get my order in.
Yeah.
And so, psychology.
If you're going to change people's behavior, you need to actually change their behavior and teach them a new way, not allow them to behave the old way just with an online format.
No, that's right. And obviously, food delivery is big in the news these days, big in VC world, and between Instacart on the grocery side and Uber Eats on the restaurant and Grubhub, and we saw what happened to Munchery just the other day. And I got involved in an interesting tweet thread the other day about food delivery, and what I said was, look, at its core, this stuff is not technology. It's logistics. People have to make the food. People have to deliver the food, right? There's no scale in, work hours that way, right? And either the consumer, the customer is willing to pay for that time to not do it for themselves, or they're not. Like, it's a rather...
And it's a pretty low margin. The existing infrastructure is a low margin, high volume logistics game. You can go to higher income brackets where they'll pay for convenience, but you're not going to compete on price.
No. And so the other point I made in this thread actually was, if you're going to be in this business, you cannot have a product that can that a customer can do an apples to apples comparison, right? Otherwise you're toast, Okay. Whatever you have has to not look, smell, feel, touch like this other thing. You have to have a monopoly on it. And that's the only way you're going to get the price value out of it.
Yeah. Yeah, I really thought the prepared foods, in addition to your core grocery set, was a beautiful thing with Plum Good. I wish you had that now, because it was a good combination.
No, I think you probably remember some of our conversations, because, we didn't raise a whole lot of money, relatively speaking, so especially when you think about what's happened in New York and San Francisco and elsewhere in the world. And yet what we saw was the things that we were doing from a technology perspective in terms of one-click ordering, like a recipe, all the ingredients, and having all of that box and the prepared foods and, the whole nine. We saw all these other big money companies.
Yeah, they all went there.
They all went there. They grabbed our ideas because they could see them online, and they're like, "What's Plum Good doing?" And that, and they would go at it. And the one thing that we were really struggling trying to figure out, and we were just too ahead of our time on this, was how can you easily order from your phone? Mm-hmm. And smartphones weren't actually a thing then. Right? Like
it was pre-iPhone, wasn't it?
Yeah.
Yeah.
So iPhone really came out towards the end of our life. And at that point, the other thing that we had going on was this macroeconomic collapse in the country, where the supply demand for time all of a sudden turned upside down, right? And this is very much a trading money for time equation in the food delivery business. And all of a sudden, people were flushed with time, and scarce on the money side.
Right. And so let's get back to your back. So then you jumped and became a VC. You had your own fund here in Nashville and invested in a variety of companies. Talk about the transition from investment banker, entrepreneur, to VC, because there's not enough VCs that have gone through that. I did the same thing, but a lot of VCs never actually had to meet payroll or hire staff and manage staff.
Yeah, and so I think one of the hardest parts about that change for me was trying not to tell the entrepreneur what to do.
Yeah, right. It took me probably 2 years to get through that process. Like, if you want to be the quarterback on the field, running the plays and throwing the passes, you can't be the GM on the press box upstairs.
No, you can't be player coach, right?
But a lot of times the players don't do what I want them to do. And so you have to sort of, get through that process.
Including me with you.
Yeah, that's right.
And that's that's a tough transition. And what I found through this process, so I'm going to rewind for a second. And what I'll say is, what we did with the fund was made very early bets and large bets on a few number of companies in areas that we thought had the opportunity to return the fund multiple times each one of those investments, right? And so that was our thesis. And what's changed about Nashville today versus sort of 10 years ago when we started it is that I'm not going to say it's a lot easier, but it's a little bit easier to attract outside capital to Nashville today than it was 10 years ago. And, to proof positive is we announced yesterday with Alto that we just closed a $2.8 million seed round.
Congratulations. I didn't know that. Congratulations. Good.
Thanks. And Foundation Capital and Sequoia Scout and Amplify LA and Alumni Venture Group, all institutional investors, not from here, all participated, right? And so I think that's proof of movement in the right direction for Nashville and what everybody in Nashville is doing and the growth of the creative class here. And you've been a big part of that, and what you've been doing on the healthcare side. And so I think everybody else, Nashville, over the lifetime that we've been here, which is 16, 17 years, right? We've gone from an MSA, which was probably just under 1 million, to one that's just under 2 million, I think now. I mean, that's incredible growth.
And even in the last 5 years, so Marcus and I started Jumpstart 5 years ago. We looked around, and really, as you went to Silicon Valley, New York, Boston, LA, even Chicago, Dallas, unless you were doing healthcare, Nashville was not in the discussion. And so we're not super smart, but as we heard that for the 8th, 9th time, we decided, let's just do healthcare.
And we talk slow.
Right, yeah, exactly. And so, but now I think it is coming around with the technology scene, the restaurant scene, the creative class is really kind of growing, and firms like you just attracted are coming to Nashville to check out what's here. And there's some great technologies and great companies here.
Yeah, and I'll plug your partner Marcus for a second, because he's gone back to, I shouldn't say gone back. I mean, he's taking his blogging to a new level.
Yeah.
So I get his weekly blog post, and you know, if anyone doesn't know Marcus Whitney, it's a really great read. He's a good writer and a really interesting and super kind person, and so I highly recommend you find him online.
I agree. So let's talk about Alto. What caused you to start Alto? And then that might segue into the healthcare industry and the public markets, where I want to go.
Yeah. So if by healthcare you mean problems to solve, I think it's a great segue.
Yeah.
So what happened was I wanted to use my IRA money to invest in one of TNCV's portfolio companies.
Yeah, that was your VC fund.
That was the VC fund, Tennessee Community Ventures. And the really long story made short is that it took me 6 weeks to close an investment that I already knew I wanted to make and had already agreed to all the terms and documentation of.
Yeah.
And it still took me 6 weeks to do. Which,
and it's your money. It's your money. Just
my money
in this custody agent that's a pain in the ass about it.
Yeah. And so the thing that really just sort of made me mad was I did all the work to execute this investment, and then I wrote a check to the custodian for the privilege of having done all the execution work, right? And the only thing they do is, at the end of the day, send a valuation form to the IRS and say that they're the custodian, they're on the title. And this made no sense to me. And by the way, it wasn't cheap. And so it wasn't cheap. And I began to think, wow, this price cuts out most of America, because you have to have a certain level of savings to make an investment that you could justify this alternative IRA account.
And you have to be very experienced doing VC work to be able to know how to do it, know how to navigate it, fight through all the red tape, and kind of cause those battles. And so it prevents most of America from using their retirement savings in alternatives.
That's exactly right. And so, you know, this first time around, I thought, well, maybe I just chose the wrong custodian, right? Like maybe I chose poorly. And it has, for a long time, for over 40 plus years since ERISA was created, mostly a mom and pop industry. And because nobody knows that you can use your retirement savings to invest in alternative assets. So I thought, well, maybe I chose poorly. I mean, I did homework, I did research. I thought I had sort of like the industry leader, right? They're out in California. They work with all the tech people. I thought, okay, these are the guys. And so I made 2 more investments. I chose 2 more custodians. I had the exact same experience, at which point I said, okay, am I the only one having this problem? Is anybody else frustrated? How many more people want to do this? Right. And so big picture, we've got roughly $30 trillion today sitting at, that's trillion with a T, sitting in retirement savings accounts, with roughly only maybe 1% invested in alternative assets. And so there were some really significant trends which attracted me to try and solve the problem. The first is that we had, somewhere between 8,000 and 9,000 public companies about 20 years ago. Today, we've got less than 3,700, and only 200 plus or so of those companies account for all of the returns in the public markets. And the whole financial advisory space, wealth management, RIA space has moved towards this passive approach to investment returns, right?
It's easy for them, right? But they're charging you a fee to buy
exactly
indexes. Yeah.
Right. I mean, I can pick a mutual fund,
right.
and the funny thing is, right? And I don't mean to pick on the wealth management industry.
It's wealth management, it's brokers, it's the investment banks. They're all the same. They're incentivized for long only, hold forever.
Right. And by the way, I want to distinguish between those who are putting you all in passives and those who are actually building portfolios for you. The people that are building portfolios, whether they win or lose for you, whether they outperform or underperform, at least they're doing their work.
They're actually trying.
Trying. And 90% is showing up, 10% is, doing the work and making a difference. But so all of these passive vehicles, mutual funds, index funds, ETFs, they're all comprised of the same combination of the 200 plus companies in the public market that produce the returns, which means all of the alpha, all of the potential excess return is gone. Plus, we have downward pressure from baby boomers who have to sell their holdings to, support.
Okay, so that's one of, so I have a prediction that has gotten a lot of attack over the last couple months, but my prediction is that the stock market peaked in 2018, in sort of the fall of 2018, and there's two trends that are going to really be flat or down over the next 10 years. One is that I think the boomers are going to pull money out of the stock market, and it's purely funds flow. They're going to move money out to pay for their retirement, pay for healthcare, pay for whatever, and they're not generating wealth anymore. They're spending down their wealth. And it's very normal for people to move out, but there's a lot of them in boomers, and there's not as many our age that are contributing. That's one. And there's only a couple hundred stocks, and you can pick where you want to sell from, but it doesn't matter. They're all going to sell. Then the second is that the healthcare industry is what I specialize on. I spent a ton of time looking into it. I do, as you know, only private early stage investing. But we sell things, we sell as customers, and we get companies acquired by the big publicly traded companies. So it's my job to study them. They make up 20% of the economy. It's $3.5 trillion in revenue every year. And that business is being attacked. There's several trends that the margins are being compressed, smaller and smaller ability to kind of have a moat and protect your interests and guard against kind of competitive pressures, huge regulatory push to reduce costs and open up access. And so that sort of last protected 3 trillion, 20% of the economy, really kind of wealth generation machine that is a lot of the public stock market is going to have a lot of trouble. I mean, big companies are attacking it, and private equity and VC like me are attacking it. And if you're not in that game, you're just missing out. It's going to be sort of downward pressure over the next 10 years.
And I'm rooting for you as well as the rest of America, by the way. Attack. We paid 2 or 3 times as much money for healthcare, and we're ranked 47th in outcomes. It's terrible. I mean, we don't have good quality. Yeah. Yes, is all I can say. And so I'm going to finish the other side of this, which is the large private companies are not going public anymore.
Right.
They're staying private. With if you raise $50 to $100 million, you used to go public on that.
Right.
Right. And your valuation was in the hundreds of millions.
Right. And then my IRA could go into that. Now you're staying private to $1 billion, $2 billion, $10 billion, and either never going public or only going public once all the growth is gone.
Right. That's right. So that upside has all been absorbed by the early stage and later stage private investors, right? And so if you're not participating in the private markets, you're not going to retire. And that's what drives me. It's like America needs to be in a position to retire, and we've only got 3 ways to do it, right? We can earn more, we can save more, or we can make our investments do more for us. All right. I don't like saving.
You probably need all 3, right? You need to at least have a strategy for all 3.
Exactly. And we all want to earn more, or I think most people want to earn more, right? The thing that troubles me about saving is I view it as a passive activity. By saving, that means I'm not doing something. With investing, I'm being proactive. I'm taking agency. I'm owning my actions for my future. And so the question is, how do we help educate people? How do we teach them? How do we provide them access to the private market opportunities that up until now, only the really wealthy have had access to? Right. And the good news on this front is that we've got something called the Jobs Act, which is the Jumpstart Our Business Startups Act.
Right. I love that they took my name. It was really nice of the administration to take my name.
Yes, exactly. And so it was passed a few years ago, and in that act was Title III, which created what's referred to as Reg CF, or regulation crowdfunding. And what that enabled is for everyday Americans to participate in private company investment. Now, to be clear, I'm not saying take your $10,000 and go bet it on one company, right? You don't go to Vegas and take all of your savings. Some people do, maybe. Don't take all of your savings. Go to one of these Reg CF platforms and bet it all on one company. Right. The whole point of these platforms is that you can now build a diversified portfolio at any monetary scale. So if what I have is $10,000,
you should be spreading that across. I mean, I think the number is 50 to 100 assets. You should spread it across.
I agree. I agree. And by the way, all of the economic data or statistics, and I know there's lies, damn lies, and statistics, but that said, if you have a portfolio of 50 to 100 companies, the odds are significantly, that was a tongue twister, in your favor. And so that's the idea. One other thing I want to point out is it's not all about early stage companies. You can also invest in current pay real estate, right? Yeah. You can do commercial, you can do residential, you can do multifamily home, you can do accounts receivable financing, litigation finance. I mean, the world is your oyster.
The institutional investors have been doing this since Yale started in the 80s. They get sort of a well-diversified portfolio of all kinds of alternatives, and it turns out that when timber does well, the real estate market doesn't do well. And when oil does well, something else doesn't do well. And it doesn't matter to me what is going to be great in the next year. You need to be across all these alternatives. What matters to me is that you don't believe what your wealth advisor says that you should be in a 60-40 equity bond mix of indexes. That's not right.
Who said that?
Well, it makes them a successful fee generation machine.
Yeah, and it's always 60-40 stocks bonds, right?
Right.
Equity to debt. Yeah. What's Yale's portfolio look like? What's their endowment look like? 80 to 90 alternatives.
Right.
The remainder in public equities.
Yeah. So I think as you get older, you need to start thinking about liquidity. So the one thing I'd add is, as you start thinking about, like, I'm not working anymore, I'm going to retire, you probably need 2 or 3 years of liquidity source. And then you have kind of a public stock portfolio, then all your alternatives. And you can play with the percentages, right? But you probably need, depending on your net worth and your spending amounts, you need 10, 20, 30% in some kind of liquid thing that you're buying groceries out of. And then you have kind of a public stock that's what you're going to use in 5 years to transition to that. And then your alternatives. So the alternatives are going to be longer dated and longer life.
So you bring up a couple of really great points that I just want to add to. The first is, especially for those who are listening that are in, let's just call it what it is, the millennial generation, right? you have an opportunity now to invest for the long term.
Yeah, you have a long time horizon, and you don't
That's
need
right.
the cash today. Yeah.
And your IRA, you cannot and should not touch until you retire. Now, the conventional wisdom up until today has been sort of like that 60-40 split.
Yeah.
Got to invest in conservative stuff. Like, take risk with your after-tax savings, your after-tax income. It's entirely backwards.
Right.
It's entirely wrong.
So do you have an example or how the math works? Because I think there are really good examples of that.
Yeah. So probably. So what Vic is referring to right now is essentially compounding returns and not having to pay taxes.
Like after tax compounding. Right.
That right. So if you were to take $100 and invest it in something, and let's say that doubled, and so the $100 became $200, and this is after tax savings. Well, let's just say let's just pick an easy number. You're in a 25% tax rate, right? You're going to pay 25% on that $100 gain, or actually, it's going to be you're going to have capital gains rate. So you're going to pay 10% on the 100.
Yeah. So now you only have 190 to reinvest.
So now you only have 190 to reinvest, and if you do that, let's call it 40 times over. Call it a 40-year, and maybe you do it once a year, right? You're going to have a given number, and you're paying tax every time as you go. In an IRA, which is either tax deferred, or a Roth IRA, which is tax free, right? You're not paying tax that whole period of time, and that what I call implicit leverage in your account. That builds over time. And so at the end of the day, and I don't have exact numbers, but it's easy to look up if someone wants to Google, compounding effect of, taxes, et cetera. If these were two bars, your returns of your IRA account would be up here, and your returns of your
instead of sending that $10,000 every year to Uncle Sam, you're reinvesting it, and it's working for you.
That's right.
And then you get the compounding over many years of that. And so we should do that with our high risk, likely to have big returns part of the portfolio.
Also our current pay assets. So if you invest in real estate that has current pay, you don't want to pay taxes on that, right? You want to protect that interest. Okay.
Yeah.
So, and be able to, because the interest carries income tax, not capital gains. So that's
so talk about Alto and how it fits in with a platform like Jumpstart or a platform like AngelList or other platforms, because you have lots of partners. I sign up for Alto, and then how does it work?
Yeah. So we are your alternative IRA custodian. Okay, which means we're going to help you do all the reporting at the end of the year for the IRS. And more importantly, make sure you don't enter into what's called a prohibited transaction. And if you enter into a prohibited transaction, you actually blow the tax protection of the account. And so we sort of view our most significant role not as IRS reporting, but making sure you don't do something you're not supposed to do.
Yeah.
Okay. With your account. So if someone wants to invest in a Jumpstart fund, right? They create an account at Alto. Jumpstart. So one of the really unique and interesting things that we've done with the Alto platform is we've made it two-sided. So we have investors on one side and issuers, companies, funds, people raising or borrowing money on the other. So Jumpstart comes to Alto, they create their Jumpstart account, they put their offering documents up onto our platform, and then they invite their investors who they know want to use their IRA savings to invest in the funds.
Yeah.
Okay. And so we automate unlike my first process where it took me 6 weeks going back and forth between the company and the custodian and signatures and deal offering updates and all this stuff, all of the necessary material lives in real time on the Alto platform. Okay. And so everything happens electronically.
Yeah.
And, all of the review of documentation, all of the signatures and whatnot. And the nice thing here is an investor, so let's say there was an investor who wanted to invest in Jumpstart. She would come to Alto, she would create her account, and then she could actually issue an invitation to you at Jumpstart to the Alto platform. You would then come create your account, upload all the deal docs, and she would automatically have access to those deal docs, right? And so we've built this platform where investors can invite companies and companies can invite more investors.
Yeah, so it can grow from all sides kind of organically. Yeah.
That's right. And then the way we work with platform providers like AngelList and WeFunder and Silicon Prairie, Republic, Ground Floor, Yield Street, Forge Global, is that we work to automate the process so that the investor never has to collect documents and to take the work off of the investor relations team at the investment platform partner, right? So if you're making an investment at AngelList in a syndicate or an early stage company directly, when you indicate that you want to use your AltoIRA, AngelList immediately creates an offering at AltoIRA electronically in the back end. It's completely seamless. And so we get all the right bank information and deal offering documents. And it's a 2-button click, 1 electronic signature closing process for the investor.
We sort of blew past it because I got super excited and you got excited, but talk to me about your view of healthcare. Where do you see it going as a patient, as an investor? Where do you see kind of the healthcare market space?
Well, so I'm not a healthcare investor, thankfully for everybody. And, but I am a consumer of healthcare, as is unfortunately everybody. And so my views, I think, are strictly limited to my experience as a consumer and customer of medical services, let's say. And what I don't understand, and I think, by the way, the problem here is a 2-sided coin. Most coins are 2-sided, with pharma on one side and the insurance industry on the other. Right. And by the way, doctors played a role in this too, probably 30 years ago, right? And I don't know exactly, you can sort of correct everything that I say that's wrong, because I'm about to give you my impression of the way or why we got to where we are today. And I think as the insurance industry was growing up, they went to a bunch of doctors and said, hey, we're going to pay you X dollars per head to serve our clientele. We're going to go out and we're essentially going to go acquire customers. We're going to go acquire patients for you, and we're going to pay you X every time you see them. And
every procedure, every visit, or whatever it is, every operation.
Right. Okay. And the early doctors to do this thought it was awesome, right? This is like free marketing, free customer acquisition, right? And the first ones to adopt it, I'm sure, made a boatload of money, right? But slowly but surely what happened was the leverage flipped. So those early doctors had some leverage in the conversation. Yeah. And slowly but surely the leverage flipped such that, well, if you don't accept our insurance, you're not going to get any patients.
Right.
Right? Okay. So now all of a sudden I have to have someone working in my office as a doctor who can negotiate with the insurance company, get procedures approved, figure out bills, get reimbursement. Total administrative headache, right? And then pharma comes in, and pharma says, well, we need to make a certain amount of money because we have big R&D budgets, right? And so the insurance industry says, that's great. you can make a lot more money on the people that don't have our insurance, but we got a lot of people. So you have to charge them. So you have to charge our people, essentially us, less, for the same drugs, right? So then we get this huge markup in drugs, just so pharma can turn around and give a huge discount to the insurance companies, right? And I hate it. So I absolutely.
I agree completely that it's all about misaligned incentives for 50 years. And they are so misaligned that we are not bringing transparency or outcomes. The buyer, the patient, has no ability to influence things. And that is changing. People like you are rising up and taking control. They're demanding information, authority, and they're also being asked to pay for more. And over time, that will shift things. The other thing I think that's really interesting is care is moving outside of the hospital into the clinic or the neighborhood or the home. And it's a lot more effective, it's better for the patient, and it's a lot cheaper to do that.
And so I'll give you an example, right? And God, incentives are so misaligned, right? So at the end of last year, because I'm about 50 years old, I had a colonoscopy, right? Totally clean. And I say that because I've had ulcerative colitis for, I don't know, 10 or 12 years, something like that. And I've been on the same medication. We switched insurance companies at the beginning of the year. What do they say? Oh, we don't support that med. You have to go to this other med. Talk about stupid, right?
This is working. Everything's going well. Yeah.
Right. So what you want me to get sick and then cover surgery?
Right.
Because that'll be way cheaper than you just letting me stay on the med in which, I just got my best colonoscopy in 12 years.
Right.
I mean, and I had this vision, and by the way, I don't watch The Simpsons, but I have this vision, right, where Bart Simpson in some crazy accident loses a limb, and they rush him to the emergency room, and the arm's being sewn back on, and there's a nurse in the emergency room that's calling the insurance company, and the insurance company said, well, we need proof that it was off. And they're like, oh, wait, we got to undo all of the stuff so we can take a picture, and then we can, that's what I think of the healthcare industry.
Yeah, right. But then they'll charge you twice. Well, now we've attached it twice. That's 2 procedures. So let's bill it twice for that.
It just, infuriating.
Well, and you were in banking. If you compare that to fintech, the incentives are it's cutthroat, but the incentives are very aligned.
Very aligned.
You can shave 5% off. You can offer a 2% lower price and get a bunch more market share. And it's just very aligned. So everyone is pushing for the best interest of the customer for their own best interests. And that's going to come in healthcare, but not for a couple of years.
And by the way,
in the audience that really wants to use their IRA or get involved in alternative investing, but they haven't to date yet, and they've been watching my blog and listening to things, which is interesting, but they haven't taken the time or effort to educate themselves. How would you suggest going about that? Are there websites? Does also give education? Where do you think they should go to get education?
So for the first thing I'll say is that we are not a financial advisor, and we don't make recommendations. Essentially, we help you do what you want to do. Mm-hmm. All right. So that's about Alto. The next thing I would say is that educating yourself is the first step and the most important step in the process. And, if you're an accredited investor, I don't know what your minimum check size is, but there's probably an opportunity to take your IRA and participate in a fund like Jumpstart, where you get to watch what happens at Jumpstart, the portfolio they build, why you invest in the companies you invest in. So that's one way to do it.
You take a small amount of money and you learn by following it. I know I'll pay a lot more attention after I put a little bit of money in. And it's sort of an incentive for me to learn more. And then as I get comfortable, I might do a direct deal, or I might pick another fund on your platform. Yeah.
That's right. And so the other thing that you can do is you can go to one of these. So if you're not an accredited investor, and even if you are, you can go to one of the Reg CF platforms, which is WeFunder, Ground Floor, Republic, that are integrated with us. There are others. Yield Street, I think, will ultimately have a non-accredited offering as well. But you can go there, and in order to be listed on a Reg CF platform, you have to go through a significant amount of due diligence just to get on the platform.
Yeah.
And the companies doing the diligence take this incredibly seriously, because they know if they don't put good deal, if they let just anybody up, it's not going to work, right? So what I would say to you is, don't trust the SEC, okay? And the company I'm going to pick on is Blue Apron, because I know the business.
Okay.
So when I saw Blue Apron go public, I thought, oh my word! Like, the only reason Blue Apron went public is because they couldn't raise any more money.
Yeah. Right, they're burning money. All those food delivery things are burning money. Yeah.
Right? You know, and now, all right, I'm not going to go back to food delivery because we're talking about IRA investing.
Right.
But just because the SEC says it can go public doesn't make it good.
Right.
All right? And I'm going to say the same thing to the Reg CF platforms, right? They are and what I will say is the Reg CF platforms are actually more invested in making sure that the quality of deal that they list is above a certain bar, unlike the SEC, okay? And so I think that's a good place to start. But what I will remind people is invest in what you know, right. Not just what may be interesting, but what you know, and do some homework and figure it out. You're going to be wrong, by the way, right?
Yeah, you're going to be wrong. But if you do a big portfolio and then you invest in some funds that also, so like our funds have 15 to 20 assets in each fund. And so you can put you have to be accredited, unfortunately. So we're not accepting unaccredited investors, but you can put a small amount of money across 20 assets. And then that can be your first investment. And you still should build a 50 portfolio asset of that.
So one of the problems with the Jobs Act in Title III, by the way, is it doesn't allow non-accredited investors to invest in funds. And the House has already passed the bill, and hopefully it's going to get out of the Senate, because that's exactly how non-accredited investors should be starting to invest.
You'd be better off in my fund than doing one-off things, right?
Exactly correct. So hopefully we get that bill out of the Senate. And if you have any pull there, Vic, please, push.
I have no pull, and I don't have a lot of confidence in our politicians, but we'll see. Once in a while, a blind squirrel finds a nut. So.
Yeah. So if we can get that through the Senate, then we have non-accredited capability to invest in funds. And I think that's the best way to kind of get started, right? Because you watch the portfolio. The other things that we're going to be doing at the AltoIRA website is building a community such that you can follow experienced investors to see what it is they're investing in and why. Okay. Yeah. And in that community, we will have the people who have AltoIRA accounts, they can post and comment. Other people can just come and read. All right. Mm-hmm. And so you can look to follow. And then we have another really significant idea that I'm not going to share right this second. But we think there's an opportunity to help people get smarter about alternative asset investing, and we know it's really important to do.
Right. Well, it's really about helping people. Give people your website. So it's altoira.com. Is that correct?
www.altoira.com.
Yeah, and we will put it broke up a little bit, but we'll put it in there and make sure people can find it. Super excited that you're doing that here in Nashville. Now you're funded. I can't wait to see how it grows.
Thanks, Vic.
Thanks,
really
Eric.
appreciate
it. Bye.
You having me on.
Yeah. Bye.
Bye.